talk more about the moves that we're seeing in equities. Big tech once again lower today. Now the move coming after yesterday's tumble, which marked the worst first trading day for the Nasdaq since 2016. Here with more what we could expect going forward, we want to bring in Kristina Hooper, Invesco's Chief Global Market Strategist. Kristina, it's great to have you here. So I think investors are maybe a bit nervous about what the next several weeks, several months could potentially look like following yesterday's sell-off. What do you think?
Well, I don't think there's that much cause for concern because we have to look at the reasons why we're seeing that tech sell-off. First of all, we had a really strong rally, so it makes sense that there would be some digestion. The real catalyst, though, has been an increase in rates, and that's really about fears around the FOMC minutes coming out today, as well as the jobs report on Friday. Essentially, as well as we're getting a little Fed speak that's hawkish, more rates aren't off the table. But we have to recognize that that's part of a process in which we're seeing this pivot occur. The Fed has a real reason, a genuine interest in tamping down the easing of financial conditions. So they're going to talk hawkish. We're going to naturally have jitters around any kind of data releases right now as we wait for that true policy pivot. So to me, this is a pretty short-term blip.
And Kristina, in looking at 2024, you look back at last year, and one of your big takeaways is that it's really all about monetary policy and where things come down for the Fed. And I do wonder, is that, and we've talked about this a little bit in the office, is that something that is always the case, or is that just this moment in time? And how do you see that playing out, I guess, not just this year, but thinking over this full cycle?
So it depends on how old you are. I'm old enough to tell you that's not always the case. But if you came of age during the global financial crisis, it has been the case since then, really. Monetary policy has dominated and driven markets. And especially as we transition from an ultra-low, extraordinarily abnormal rate environment to a more normal rate environment, there's likely to be a lot of volatility and uncertainty, and that's what we're experiencing. But I think that there will be a point where monetary policy won't have such an outsized role. We're just not there yet.
And I guess in thinking about the markets over the last couple of years, a lot of folks were noting at the end of December, go back 2 years, it's kind of flat. Like it was sort of, we went all the way up, we came all the way back down, we made it all the way back. And I'm wondering, over time, looking at, style selection that investors can have within a portfolio, is that really just a reminder that, do your 10-year CAGRs, your 20-year CAGRs, like that's how you have to think about things? Like, I know it's the big pitch, you got to be diversified, but you have to look at that timeline. Otherwise, you're just going to be sitting here at this desk worrying about every 2-day move.
Well, that's the point of diversification, is that it makes you worry a little less. But certainly there are going to be areas that perform well for years. We've seen technology be on a juggernaut, but when it's down, it's really down, and it's so nice to see other parts of the portfolio that can soften those blows.
Kristina, how much is riding on earnings growth here for 2024, just in terms of the expectations, given the lofty valuations that we're especially seeing in some of those larger cap tech names?
So, it's interesting. If we talk about valuations, yes, they've gotten stretched. But if we were to drill down, it's really a sub-segment of the market, and it's largely tech, as you pointed out. And there are other areas, like small caps, where valuations look rather attractive. So if we think of 2024 as a period for the market of broadening, then I think we're more comfortable with the idea that valuations are going to differ. Now, I think it's also important to point out that valuations are not predictive typically in the short term. So we can, winners can run for a while, high valuations can run. My view, to answer your question around earnings expectations for this year, my view is that we can see a continued rally in stocks driven by multiple expansion as rates go down. It's not going to be, I think, a big earnings story in the near term. And hopefully markets recognize that. I don't think we're going to be positively surprised by earnings in the near term.
And I guess we'll get you out of here on 2024. Maybe something that you're thinking about or that you see as a possibility for in the markets that maybe investors aren't building into their base case. We've talked a lot on the show already about the broadening, about where macro goes. Are there other things that you're thinking about for the year ahead?
Well, one kind of key component to many people's portfolios as they enter 2024 is an overweighting to cash. I mean, that's a reality that we've seen in a variety of different statistics. Now, I think it's important to have some exposure to cash. That's part of being well diversified. But for those that are overweight cash, it is time to look for opportunities. And I think that it's not just going to be about equities. I think we're going to see a real move towards fixed income. Investment grade credit, and even emerging market debt, going long and locking in those high yields while we still have them.
All right, we'll leave it there. Kristina Hooper, Invesco's Chief Global Market Strategist. Appreciate the time.
Thank you.